Veterans Association of Real Estate Professionals. How many people in here are part of that here in Missouri? No. And I can say that because I'm the only one. So, yeah. So this is an organization that does a lot within the VA hospitals and a lot within the Board of Realtors in other states. For some reason in Missouri, there's really, that I can find, there's nobody else signed up. They have a lot of information, slides, lunch, things you can do lunch and learns with, all kinds of materials that you have at your access if you're a member of that. Yes.
Do you have to be a veteran?
You do not have to be a veteran. Well, I'm pretty sure you don't have to be a veteran. I'll have to double check that. It didn't ask me if I was a veteran, so I assume that you don't have to be a veteran. But it's really all about providing the material that veterans need. So they have two websites, one for professionals and one for actual veterans to log on to. So basically the goal of the VA rep is to preserve the American dream of home ownership for U.S. service members and veterans of all eras. Why they exist is just to be able to do this stuff, because to be honest with you, when I got out of the military, no one ever sat me down and said, hey, you now qualify for a VA home loan. There's no information that you can log in and find, or at least there wasn't back then. And so there's a lot of people that I come across on a daily basis that say, I didn't know I could do a VA loan. I didn't know I was eligible for the VA loan. And this is a survey that was done. Can you guys read that okay? All right, we're going to email this to you guys along with any questions that you might have. We're going to take notes and then email you stuff. But there's a ton of veterans that are unaware that they qualify for the VA loan. And so it really is all of our responsibilities as lenders and realtors to make sure we know that this product's available to them, because it is a huge benefit and it can save an individual thousands of dollars during the course of home ownership. A lot of military individuals, the pay is not great. I will be the first to attest to that. But they do provide you with housing and food and healthcare, so what you do make is not bad. But a lot of veterans do have financial problems. So a lot of spouses of veterans don't work. It's hard when you're in an area for a short period of time to get gainful employment and then uproot and move somewhere else or go somewhere else, depending on the branch of service. But a lot of times they have some financial stress related to their situation. And a lot of veterans just don't think that they can afford or that they qualify for a home loan. And to be honest with you, the way the VA is set up, there is a lot of flexibility within the VA home loan. The ratios, what they allow for ratios are extended. There's a lot of things that you can do. Have you guys all heard of debt to income ratio? Have you heard a lender or somebody tell you about that?
Yeah.
So the VA loan actually has probably if you have good credit, we've seen the back end ratio. What's the highest you've ever seen, Bobby?
Probably 65.
Yes, like 65%. Yeah, so it's kind of crazy. But if you've shown a history of sound financial practices, you're going to probably qualify a lot higher than most. So get into here. So this is kind of information about the VA loan. Basically, a VA loan is for veterans, active duty, National Guard, or reservists. It is a 100% financing loan, meaning that someone can get into the home with zero money out of their pocket. They can actually have the seller pay all of their closing costs. There's not another 100% secondary market loan besides USDA that's available. And the beauty of this is there's no mortgage insurance. So with the VA loan, you can get into this cheaper than any other loan product out there because it has the lowest available interest rate. So it's actually lower than conventional. There's no monthly mortgage insurance. And it's just a really all-around great loan. Another thing with VA that's kind of unique Now, I believe that FHA allows this also. If a seller, if a seller is going to pay closing costs, there's no limit on the amount of closing costs. So if it's a legitimate closing cost, they don't say 6%, 5%, whatever. It's legitimate closing costs. In addition to that, they allow an additional 4% to go towards seller concessions. That can be as something as if an individual has a car loan with Blue Current and it's a $3,000 car loan and it's $200 a month, that it impacts their debt to income ratio. And as long as we fit in that guidelines, they can qualify. They can pay that for the buyer for them to qualify for a home loan. That's still correct, isn't it, Bobby? Yeah. So, and it's in certain situations where we've had it where somebody has to pay something to qualify. So it does happen. In this market, probably not as much because a lot of people are getting full price offers. But when you're in a slower market condition or a house that hasn't sold as fast, and you get somebody that's interested in it, but they may not qualify because of debt to income, try to remember that, hey, maybe we can work a deal with the seller to pay a debt so that they can qualify for the home. What else? Let's see. So you got to have decent credit. 580 is kind of a credit score that we go with. But I'm going to be honest with you guys. Other lenders might be 620. They might be 640. You might find somebody out there that'll say 500. 500 credit, yeah, no, it's crazy. It basically, there's no, VA doesn't put in their book, you have to have a 580 credit score. VA says that the credit has to be by the underwriter, look at how their credit history is and how they've paid in the past. So individual lenders will set up this is called an overlay, and the overlay for us and most of the people that we work with is a 580 credit score. What we're looking for really, guys, is the last 24 months. So how many lates has somebody had in the last 24 months? How have they paid their stuff? If they're a 580 and they've got 3 or 4 30-day lates on a couple of accounts, they're not going to qualify. And because VA says you can have 2 30-day lates in 24 months. And so we just have to look at all that and double check to see if they qualify. Now that doesn't mean that I'm not going to try to run it through the automated underwriting. So there's a program that all underwriters use and lenders. It's an AUS, an automated underwriting system. We would run that through, and if the findings come back and say that it's approved eligible, then we're able to move forward with that because it's been approved by that system. That's only if the underwriter, like Bobby, says, nope, this is the guideline, and it's an automated or it's a manual underwrite. We have to follow what that says, and every lender has to follow what that says. Sufficient debt to income ratios. The VA doesn't have normal ratios like Fannie Mae and Freddie Mac and FHA and USDA. So those ratios normally are 29% on your housing. So you take your gross monthly income times 29%, and that's what they allow for a housing debt. The back end ratio on an FHA conventional that typically is 41 to 45% in that range. VA just has one ratio. So it doesn't matter if your housing is all you have, they try to keep you around 41%. But with good credit or great credit, we've seen them as high as 65% on the back end. So it's a really, really good loan. Valid certificate of eligibility. What that is when a member serves, the VA has a portal that we can log into, and the veteran, and request what's called their certificate of eligibility. That certificate of eligibility does a ton of stuff for us. One, it tells them whether they are exempt from a funding fee, which we'll get into here in a little bit. It tells us if they receive a certain amount of money monthly for a VA related disability. It tells us their entitlement code, whether they were a reservist or an active duty military person. It tells us if they have a prior VA loss. So let's say that an individual back in 1975 got a $35,000 house and had some financial difficulties, and the house went into foreclosure. VA's the only place that looks at that stuff differently. They are the most lenient when it comes to that, but they're also the most unforgiving when it comes to your eligibility. So if you've had that loss, they're going to go in and say, hey, you've lost a portion of your entitlement because of this foreclosure, even though it was 25 years ago. So it's really important that we before we send the pre-approval out, because if somebody pops up and it's a $35,000 home, they actually will be ineligible to buy a home up to $144,000 because they've used that. Isn't that the? Pretty sure that's the. You lose all of that eligibility up to the basic entitlement.
You lose the portion that they lost.
Yeah. So I'm pretty sure, and I'll double check this, guys, but I'm pretty sure that they lose that basic entitlement eligibility because it was in that first area. But I'll double check. It might be less than that. I think it's the whole thing.
I mean,
basic.
I have seen it less than if they lose just a certain portion where VA
Okay.
didn't recover that, then that's all that they would lose. So they'd
Okay.
have a portion of their regular entitlement.
So if the VA sold the house and then
Correct.
recovered part of the money,
Mhm.
that it would only be okay.
Yeah.
So we just have to look at that. Yes.
So you guys use this portal and the potential buyer doesn't have to dig all this
No.
up. You guys,
Yeah.
because a lot of lenders, you have to dig it up.
So that is a major difference with us and a lot of lenders. Not to kind of toot our horn, but I am so passionate about the VA loan only because when I moved here from Columbia, I was told by a local lender I didn't qualify for the VA loan again because I'd already used it in Columbia. And it happens all of the time. It's amazing how many people say, "Oh no, you can't do. You can have 2 VA loans at one time. You can have 1,000 VA loans. There's no limit on the number of VA loans you have. It's all based on your eligibility." Okay. So one of the things that I work on is how can we get, because that's a thing that a lot of lenders have a problem with, is certificate of eligibility. They're like, nope, you got to find it, and then nobody knows where to go and all that. Especially if you're in reserves or National Guard, it's super hard because a regular military person, when you serve, you get what's called a DD-214, and the information that's provided on that helps the VA assess your ability or your certificate of eligibility. In reserves, it's a point total. So it's all about how you serve. If you did 1 weekend a month, 2 weeks in the summer for 6 years, more than likely you're going to qualify. But if you did 1 weekend a month and 2 weeks a year for 5 years and 11 months, guess what? You're not going to qualify because it's that you have to have that. And a lot of people don't understand it. The problem with that is that you actually have to go back to your prior, where you served last, get them to give you the information, send it in possibly into St. Louis, the Department of Records. They then classify the point total. Then it gets sent up to the VA. That's the normal channel. We actually circumvent all of that because Ashton back there figured out how to sweet talk somebody at the VA, and we get these things in about 2 days now. So, yeah. So we're really good at getting those things. I mean, really good. Matter of fact, I had a guy that had been to 3 other companies over a 2-month period, could not get that, and she got that in 3 days. I was impressed, but she still didn't get a raise, but I was impressed. So, yes.
Yeah, I was just gonna say, that's how they say KSC had it recorded.
No, my DD2.
Yeah. Yeah. So once you, like a DD-214, once you get that, they're fairly easy to track down. Once you have your certificate of eligibility, it's loaded in their system, so it's pretty easy to get. But that is one thing that before you go out showing a veteran a home, you want to make sure that they've received their certificate of eligibility because that can really dictate what's going to happen with them and how quickly they're able to buy. So who is also eligible? A veteran and or a veteran spouse. Not fiance, not girlfriend, not significant other. It's a veteran and their spouse. So another unique thing about us is that I'm an ordained minister, so if you need to get somebody qualified, you laugh, I did it in August. It's crazy. People he texts me in the morning, he goes, "What are you doing on the 23rd of August?" I go, "Probably going to the lake." He goes, "Can you perform a ceremony?" Sure. So I did his loan, and then in September we closed. It was beautiful. Or I did his marriage. And they're still together. So I'm 2 for 2 on marriages. Just be better. How many of you got done?
Couple dozen.
And they're all married still? What about you, Brett?
I'm 1 for 2, 50%.
1 for 2! Damn.
What's that? 50% is holding strong, man.
So right here, this is where you're going to go if you need that perform. Hulu, you got one down too, don't you?
2. One of them, I think things are good.
Yeah.
Yeah, all right.
2 for 2. See? So it works. So, guys, the thing to think about with that is you might have a You might have a widower who her husband had died and she would actually be able to use his benefits to qualify as long as it was a service-connected event. So if he went over and served in Vietnam and had like Agent Orange and then they documented that he died because of that, she would qualify for that. If he was disabled, she would actually be able to use his VA with the disability portion where she wouldn't have the funding fee. So I had a veteran who was not disabled, and we had a lady that he was buying a home with who was using survivor benefits from her husband who had passed away who was disabled. So on the loan, and this was the really tricky part, is we had half the people that didn't have to have the funding fee and the other half that did. And there's not a loan program that exists on this planet that allows you to do that. And so it was pretty tricky at the end to make sure that whole closing disclosure was correct. So any questions on this part here, guys? All right. So basically, who qualifies? A veteran that is honorably discharged due to injury with at least 90 days of active duty, not counting training during wartime. So we, as a country, would have to be in a wartime situation. The veteran is always honorably discharged due to an injury with at least 90 days of service. Yes, sir.
Since we've been in Afghanistan 17 or 18 years, is that considered we are at war?
Yes.
Throughout.
I know. It's kind of tricky because there are certain conflicts
Right.
that classify and there's others that don't.
Or disagreements.
So it's really going to come back to that certificate of eligibility. Okay. Because I've had it where people were called up and there was a conflict and they actually qualified for it and we were technically at war. So, yeah. So it's one of those things that it's really tricky because there's certain things like the Vietnam War, World War I, II, all that good stuff that no problem. But with this little conflict that we've had, it really does depend on the situation. So the other thing is currently on active duty. So if you have somebody that is 90 days during wartime, so they just joined the military, they're there 90 days, we're in a wartime situation, and they want to buy a home, they would actually qualify. Or they have to have 181 days in of active full-time duty. National Guard and Reserve members are a little bit different. They follow the same 90 days of service or 181 during peacetime, but if none of that exists as far as that they weren't called up on active duty, they've got to do the full 6 years of service. Now that's not 100% accurate because you can do like if you could do a 6-month thing, or not a 6-month, let's say you do a 3-month active duty, and then you only finish out with 4.5 years, you could still qualify to be able to use that because of the point total. So really, there's a lot of stuff that goes into it.
If it's a TDY type situation, that's training and that's not going to fall into that.
No, yeah. So basically, they have to be called up for an active duty situation. But training does. So training adds to the point total. So it's not. Like I've got one of the guys in our Iowa office, went to Bosnia or somewhere for like 3 weeks, and he's a reservist. That added to his point total. But he was active before, so it really didn't matter. But in his situation, it would add. So this is where people kind of get confused. We, as veterans, are given what's called entitlement. And that entitlement, there's a basic entitlement that's $36,000. And the way to think about it is the VA is covering all of us 25% of the loan amount. So what that does is at $36,000, it allows us to buy a home up to $144,000 without any money out of our pocket. That's the basic entitlement. That worked great back in 50s, 60s, 70s when houses were affordable below $144,000. Now that we've got homes that are above that, they did a bonus entitlement. The bonus entitlement follows the Fannie Mae loan limit. So the Fannie Mae loan limit right now is $484,350. So you take that number divided by 4, and that gives us our new bonus entitlement. What that means is that a veteran can buy a home up to $484,350 Well, let's say you get somebody that wants to buy out in Millwood or Rivercut or wherever, and they're a veteran. A lot of people say, oh, you got to do a jumbo, you got to do whatever. No, they can actually go up to $1.5 million, and they are putting less than 20% down. Even at 1.5 million, they're putting less than 20% down on a VA home loan. Matter of fact, I think it's 16 or 17% that they would put down with no mortgage insurance and a great interest rate. So, I'll show you something here in a little bit on this. So, well, this is what I'm showing you. So, on a high balance loan, if you got a $675,000 purchase, they want to buy out in Millwood. The average loan is usually like a 20% down jumbo kind of conventional type loan. There are some 10% downs out there, but on a 20% down, they would put $135,000. On the 10% down, they would still put $67,500 down. But on this particular purchase price at $675,000, they only have to put 7% down, and there's no mortgage insurance. So $47,662 is the down payment requirement on a $675,000 house. So it's a really, keep saying it, good loan. The formula is really simple to figure out. Remember I told you about that $121,035, that's a max entitlement. Whatever they're trying to buy, divide that by 4. So $1 million divided by 4, $250,000 minus the 121. That is how much the veteran has to come in with. It's a lot easier than that thing you gave me trying to figure out. Underwriters try to make things difficult. So the pros of a VA loan: low interest rate, rates are comparable to FHA and USDA. Typically a quarter lower than a lot of conventional loans, and that's going to be lender specific. So some lenders have the exact same rates for a VA as a conventional. The reason that rates are typically lower is because on a conventional loan, there is no mortgage insurance that's covered by Fannie or Freddie. It's now called private mortgage insurance, which is a separate company. If that private mortgage insurance company goes out, Fannie Freddie doesn't get their money back. Well, VA, FHA, and USDA are self-insured, meaning that they're guaranteeing me as a lender that I'm going to get my money back if that house goes into foreclosure. No questions asked. I get my money back, they turn around, take it over, they sell it as an REO, and take the loss and use the funding fee to, it's kind of an insurance policy to cover that. Fannie Freddie, they don't have that. Fannie Freddie, they don't offer insurance. You have to go to a private mortgage insurance company, get insurance from that, and that's how that works. So the rate on those are typically a little bit higher because they're not as secure as a government loan, and so the government loans typically have better interest rates. Again, we talked about the closing costs. Seller can pay all of the normal closing costs and up to 4% concessions. There's no prepayment penalty, and it is an assumable loan. Now, if you have someone want to assume a VA loan and they're not a veteran, the veteran that has that loan lose their entitlement for that portion until it's paid off.
Wait 30 years.
Yeah. So if they're willing to wait to be able to use their money again because they lose that portion of entitlement, I never ever tell people if you're not I know as a real estate agent it could be beneficial to make the deal go through, but honestly it's not good for the veteran. And a lot of them don't understand they lose that entitlement.
And that's totally qualified. I mean, it's not like 20 years ago when they
Yeah.
weren't qualified.
Mm-hmm.
You know, they have to qualify anyway.
Yeah, they have to qualify for the loan. They
So that they can get their own loan. The
Yeah.
only thing difference is the interest rate.
Yeah, the interest rate. So a lot of times. Yeah, that's when assumable loans happen, guys. When the rate, as you guys probably know, when rates go up, and then you've got this great 3.5% VA loan, and you're like, oh, this is cool. It is, there was a lot of that years ago. The cons are certificate eligibilities are not that easy to obtain, but we are really good at it. Guard and reserve sometimes have to contact VA archives in St. Louis, and that's a nightmare. And I'm not kidding you. Rules are similar to FHA, and this is really why I wanted Steve to come in, guys, because there are so many misconceptions about the VA loan as far as what has to happen on the appraisal and how the house has to be, and there's no way in the world that house is going to go. And honestly, first of all, if it will go FHA, it's going to go VA, no questions asked. And honestly, a lot of VA appraisers, unfortunately, put stuff on there that really they don't matter. So GFIs, ground fault, interfaith, that stuff is not. Steve will attest to this. We talked about it. If the house was built in 1960 and that's what's in there, that kind of electric, VA doesn't say that has to be switched out. It has to be the code at the time the house is built. But so many people say, nope, got to change out all these outlets, or you got to do this stuff. That's not really the case. So it really comes down to the lender you're working with, and a lot of times the appraisers that they're working with. The downside to VA when it comes to appraisers is that the appraisers are on a board or a panel. We don't select them. If they're able to do loans in Greene County, Christian County, Stone County, wherever, they're on a rotation. And if their name pops up, they can accept it or not. And that's who you get. So we have no idea who it's going to be. But I wanted to kind of have Steve talk about that, and you guys ask any questions about what to look for in a house that you're going into the list. Will it go VA, and kind of talk about that stuff? Because really what they're looking for is anything hazardous to the veteran. So exposed wires sticking out of the wall, a gigantic hole in the ceiling in the living room, a broken window, if you have a patio or a deck that's what, 18 inches?
18 inches.
Yeah, they're gonna want rails and steps down type stuff.
3 steps.
3 steps.
3 steps.
Yeah, 3 steps. So but other than that, guys, it's really, they're not
6 inch
asking for much.
That's FHA.
Let's say, shouts. I mean,
Oh, checks.
or a metal.
So, and I'll talk about the lending side of it, and he can talk about the appraisal side of it. From a lender standpoint, you have what are called unique properties. So when a Shouse came out back in the day, it was a unique property, and it was because there wasn't a ton of comparables to be able to see, one, the marketability. Because as a lender, if we have to take that property back, we got to know we can get rid of it. It's all about, can we get rid of it? We're not in the business of owning homes. We're in the business of lending money and getting our money back. A Shouse now in our area is not a unique property. It can be done on traditional financing, VA also, but it's going to come down to what he can find for comparables. So if he's in an area that there's a Shouse here, but 75 miles away is the closest one that's sold in the last 6 months, it's going to be a stretch. I mean, they allow us to go further out on comparables for VA. I mean, we can go pretty far actually, but it has to show that, hey, it's really up to how the appraiser, what they put in their appraisal, like the remarks that they make and how willing they are to really support that property and that value, saying that, hey, this is a very marketable property, they are in high demand here, this is something that would, whatever they're allowed to do, but it comes down to what they put in that appraisal. Kind of talk about what you see on the VA side, what they're looking for. This is Steve.
Really, the VAs are just safety and health issues, and that it's a functional home, that it's not going to require some major repair just after the person gets it. So, roofs, they usually generally want 5 years left of life left on it. It's like you said, I mean, it can't be holes in the walls, railings. If you walk around a home when you're listing it, think about kids running around the house. I mean, you can't have a staircase down to the basement without a railing. One of the things I run into the most is a $5 pipe on a hot water heater. And I feel guilty as all get out. Charge $150 to go back and look at a $5 pipe. If the owner's there, I usually say, send me a picture when you get it done. The appraisal will be done in about 3 days. If I get it before then, it won't be in the report. But it's mostly health and safety.